Hi, everyone. Good morning, good afternoon, and good evening. And thank you so much for joining us today. And welcome to the third and final webinar in the series on IFRS 18 presentation and disclosure in financial statements. You probably all know IFRS 18 was published 9th of April this year and is the new IFRS accounting standard arising from the IASB's work on the primary financial statements project. My name is Aida Vatreniak. I'm technical director here at the IASB, and I worked on IFRS 18 together with a super team led by Ron Hasegawa. You met Ron in some of the previous webinars, and as well as some other members of our team. And today you get the pleasure to meet Anne McGeechin, Juliana Alpmeyer, and Matma Rupasinghe, three of our technical staff who have been working on the primary financial statements. So you already got waves from them, so I'm not going to go again and say hi, Anne, hi, Juliana, hi, Matma. But welcome, everyone, and thank you for joining us today, as well as to our team in the background who is supporting the session. So before we get started on the topic of today, let me just cover a couple of general points. First, you can see on the slide, IFRS 18 and the accompanying materials are available on our website. And just to emphasize, accompanying materials are not just the standard and the basis for conclusions, but also other materials that you may find very useful, such as illustrative examples, accompanying standard, flowcharts explaining requirements, as well as our effects analysis and project summary and feedback statement. On the website, you'll also find implementation page for IFRS 18, where you can find recording of this webinar, as well as any articles we have published or that will be published as implementation period progresses. Today's webinar is focused on grouping of information in the financial statements and the changes to IAS 7 statement of cash flows as a result of this project. So we invite you to submit questions related to these topics at any time during the webinar, and encourage you to really submit your questions as soon as you have them, so we have a chance to answer as many questions as possible at the end of our presentations. And finally, as our usual disclaimer, any views you hear today are the views of us, presenters, and not necessarily views of the IASB or IFRS Foundation. So with these general points, I'm going to introduce us today. So as mentioned, this is a third and final in the series of webinars on IFRS 18. And I suspect many of you may have joined previous two webinars and may be familiar with this slide, but I'm just going to run through it as a refresher and for those who were not able to listen to the first two. So IFRS 18, as mentioned, is a new IFRS accounting standard that replaces IAS 1, and although some requirements in IAS 1 have moved to IFRS 18 as well as other standards, without change, IFRS 18 also introduces three new sets of requirements aimed at reporting performance improvements that you can see here on the slide. So the first relates to creating structure in the statement of profit or loss, but requiring companies to present two new defined subtotals. And these requirements will provide consistent and comparable starting point for investors' analysis and help investors compare performance between companies, in particular using operating profit subtotal that is now going to be defined and therefore comparable. We covered this topic in more detail in our first webinar on 16th of May, and as mentioned, you can find recording of that webinar on our implementation page on the ifrs.org. The second set of requirements requires companies to disclose information about some non-GAAP or alternative performance measures in a single note to the financial statements, and we define these as management-defined performance measures, or MPMs. These should help companies to complement information provided using the new structure for the statement of profit or loss with company-specific information about performance, and thus give investors greater transparency about these measures. And this second area we covered in our webinar that was just last week. And finally, the third set of requirements is enhances guidance on grouping of information, something we define as aggregation and disaggregation in the financial statements. And this will help ensure that investors receive material information, making financial statements more understandable and useful. And as mentioned earlier, this is the area of focus for today, together with a discussion about limited changes that IASB has made to IAS 7 and the statement of cash flows. So with this introduction, it's time for me to hand over to our super team to take us through today's topic, beginning with grouping of information. So Mesma, is it okay if I start with you and ask you if you don't mind telling us what concerns investors have about the grouping that these requirements are seeking to address?
Sure. Investors have told us that financial statements do not always include information that is appropriately grouped, and sometimes companies do not provide enough detailed information. For example, a company might aggregate items using their measurement basis and not provide additional disaggregation to reflect differences in risk, even if the resulting information is material. Conversely, there were concerns that companies sometimes provide too much detail that is not needed.
Thank you, Metma. So these are the concerns. And do you mind continuing and just telling us what is IFRS 18 doing to address these concerns?
So to address these concerns, IFRS 18 introduces guidance on whether information should be in the primary financial statements or in the notes, and enhanced requirements for grouping of information and using meaningful labels for items presented or disclosed, and specific disaggregation requirements for presenting and disclosing operating expenses.
Thank you, Matma. So we have 3 subgroups here of the requirements. So maybe let's walk through them one by one during this session, and starting maybe with the first one you mentioned here, first bullet point on the slide on the guidance on what to present in the primary financial statements versus the notes. And Matma, if I can stay with you for a little bit longer and maybe ask you kindly to walk us through this, please.
Sure. Before we get into details, it might be useful to remind our viewers of what primary financial statements are, namely a statement of financial position, the statement of profit or loss, statement presenting comprehensive income, statement of changes in equity, and the statement of cash flow. Now on to the details of guidance. IFRS 18 explains the role of the primary financial statements and the role of the notes, and companies will then use those roles to decide whether to include information in the primary financial statements or in the notes. The role of the primary financial statements is to provide useful structured summaries of a company's recognized assets, liabilities, equity, income, expenses, and cash flows. The role of the notes is to provide material information that will enable the understanding of the line items presented in the primary financial statements, and information that will supplement the primary financial statements to achieve the objective of financial statements. And it is worth noting that IFRS 18 requires clear linkage between information presented in the primary financial statements and related information in the notes, going both ways, so an investor can see where to find more information in the notes about an amount presented in the primary financial statements, and where amounts disclosed in the notes are included in line items in the primary financial statements.
Thank you so much, Mesma. So we have 3 things here, role of primary financial statements, role of notes, and then importance of connecting information between the 2 locations. And you mentioned useful structured summary as a role of primary financial statements. And this is a new concept introduced in IFRS 18. And given that this is your baby, you've been working on so hard over the time of the project, can I turn to you and ask you to explain to us the role of primary financial statements in a bit more detail?
You'd think I'd know by now to unmute. But anyway, the description of the primary financial statements as structured summaries is taken from the conceptual framework. And IFRS 18 then sets out what those structured summaries are useful for, i.e. what their role is. And that role comprises 3 aspects. The primary financial statements are useful to investors for obtaining an understandable overview of the items recognised in the primary financial statements. So, for example, income and expenses in the statement of profit or loss, and assets, liabilities, and equity in the statement of financial position. They're also useful for making comparisons between companies and between reporting periods for the same company. And finally, they're useful for identifying items about which investors might want to seek additional information in the notes. And companies will consider these three aspects when determining what material information should be presented in the primary financial statements.
Thank you. And so clearly there's interaction here between concepts of materiality and useful structured summary. And do you want to maybe walk us through and take a bit of closer look at this?
Sure. So this slide shows a diagram that comes from the practice statement 2, making materiality judgments. So steps 1 and 2 explain how an entity identifies material information. Step 3 is then about organising that material information to communicate effectively in the financial statements. An entity cannot include all material information in the primary financial statements. There just isn't room to do that. So we need a threshold different from materiality to decide what material information to include in the primary financial statements. And this is where the concept of a useful structured summary comes in. So items should be included in a primary financial statement if they are necessary for the statement to provide a useful structured summary. Detail that's not needed for the statement to provide a useful structured summary is then provided in the notes if that information is material.
Thank you so much, Anne. So just to reiterate our viewers, so we have now both materiality and useful structured summary as overarching concepts that work together. And do you mind continuing and walking us through how IFRS 18 comes in here and how it requires these concepts to be applied?
Yes, sure. So the requirements on materiality are carried forward from IAS 1 to IFRS 18 unchanged. And there's two important points to note. Firstly, a company need not present or disclose information that's not material, even if there's a specific requirement in an IFRS accounting standard to do so. IFRS accounting standards do not apply to immaterial information. Secondly, a company shall provide additional information if it's material to enable users to understand the effect of transactions and other events and conditions, even if it's not specifically required by an IFRS accounting standard. And this is the same as it's always been under IAS 1. There's no change to these requirements. IFRS 18 introduces new requirements related to a useful structured summary that mirror the requirements for materiality. So a company need not present a line item that's not necessary to provide a useful structured summary, even if an IFRS accounting standard specifically requires it. However, there are required items that relate to the structure of a primary financial statement that must always be presented in order for the statement to provide a useful structured summary. So, for example, the structure of the statement of profit or loss is established by the requirements to present operating profit and classify income and expenses in categories. Accordingly, a company must apply these requirements and cannot claim that they would not result in the statement of profit or loss providing a useful structured summary. It's also important to note that if a company does not present line items specified by an IFRS accounting standard, because such presentations are not necessary to provide a useful structured summary, the company is required to disclose that item in the notes to the financial statements if the resulting information is material. And then conversely, just as with materiality, a company shall provide additional line items and subtotals if doing so is necessary for the statement to provide a useful structured summary, even if those amounts are not specifically required by an IFRS accounting standard.
Thank you so much. And so quite a bit to unpick here, right? So materiality, as you explained, is really not changed, and we don't expect change in how it is applied, but there's a bit about useful structured summary and nuances that you explain, and I can see some questions have already started coming in on how this would work in practice, so we will come to those questions at the end of our presentation. And also, please, if you have any more questions, as Anne was explaining this, do pop them in the question box, and we will cover them at the end. But let's move on to the second part. So we have covered the first part of proposals now, to roles of primaries and the notes, and let's move on to the grouping requirements for aggregation and disaggregation. And Juliana, if I can turn this to you and ask you to explain, how does IFRS 18 help companies decide how to group information in the financial statements, given that, as we know, all companies process large amounts of information about transactions and other events?
Sure. IFRS 18 requires a company to group together or aggregate items based on shared characteristics, and separately present or disclose items that have dissimilar characteristics. IFRS 18 includes examples of characteristics for the statement of profit or loss and the statement of financial position that a company considers in making its judgments. The examples identify characteristics that are likely to relate to aggregation and disaggregation in the statement of profit or loss and the statement of financial position. Now, most of them are already referred to in other IFRS accounting standards, with a few additional characteristics that were identified as being important during the development of IFRS 18. So, for example, one of the characteristics a company would consider when aggregating or disaggregating income or expenses is persistence. So, including the frequency of the item of income or expenses, or whether it is recurring or non-recurring. Now, a single dissimilar characteristic can be enough in some cases to result in information about disaggregated items being material.
Thank you so much, Juliana. So again, here we have not something entirely new. So the idea of characteristics and what characteristics are relevant is already in some other standards, but here is a consolidation of that, and as well as some additional characteristics highlighted, as you just explained. So one question we are often asked is, because characteristics are now emphasized as so important, does it mean that companies would no longer be able to present or disclose line items that have no characteristics? So items like other, would they be prohibited applying IFRS 18? Juliana, if you don't mind covering this as well.
So in general, a company would disaggregate items based on dissimilar characteristics if such disaggregated information is material. However, if a particular aggregation comprises items that are not material, that is, if further disaggregation of that item would not provide useful information to investors, then the company needs to at least describe the item in a way that faithfully represents the characteristics of the item by using meaningful labels, such that investors can actually understand what is the composition of this item. So coming back to your question on whether a company cannot use the label other anymore, using the label other to describe an item is often unhelpful for investors. A company should only use such labels if it cannot find a more informative label. And if a company cannot find a more informative label than other, it should use a label that describes the aggregated item as precisely as possible. So, for example, other operating expenses or other finance expenses. And additionally, if the aggregation comprises items that are not material, but it's sufficiently large that investors might reasonably question whether it includes information that is material, then a company is also required to disclose further information about the amount. For example, that the items making up the aggregation are not material. Such information is actually useful because it resolves investors' questions about whether they need to know more about the item.
Thank you. Thank you so much for covering that. I know many of our stakeholders are interested in how that works. So now we have covered general principles for aggregation and disaggregation, and it's helpful maybe to remind everyone that even though project overall has focused on performance reporting, these specific requirements apply across the board, so the entire set of financial statements and the notes. And I can see some questions coming on that we will cover later on. But let's move on to the specific disaggregation requirements that are in IFRS 18, and specifically, Juliana, to area. This is one of your babies, if I can continue using this expression, that you worked long and hard on during this project on the presentation and disclosures relating to operating expenses, as we can see on the slide here. So shall we try with presentation, start with presentation of operating expenses and requirements relating to that, Juliana?
Sure. IFRS 18 requires companies to classify and present operating expenses in a way that provides the most useful structured summary of those expenses using one or both of the characteristics of the nature of expense. So, for example, raw material expenses or employee benefit expenses, or the function of the expenses within the company. So, for example, cost of sales. Now, in deciding how to present operating expenses, a company should consider factors such as what line items provide the most useful information about the main components or drivers of the company's profitability, but would also consider, for example, industry practice. Classifying and presenting expenses based on their nature or function involves the usefulness of information improves the usefulness of information for investors. Information about the nature of expenses allows investors to analyze the components of a company's operating expenses, helping them then to, for example, forecast those expenses in future periods. Whereas information that groups expenses by function facilitates the calculation of some important performance metrics, including margins such as gross profit. In some cases, classifying some expenses by function and other expenses by nature actually provides the most useful structured summary. So a company is permitted to also use a mixed presentation in some circumstances.
Thank you so much, Juliana. And we can see on the slide the right example of that mixed presentation, where here we have most line items by function, but then we have also goodwill impairment loss, which is nature line item, just to illustrate an example of how that could work. But of course, companies will have to bear in mind the useful structured summary concept and apply it when deciding which line items are necessary. So you explained how proposals requirements apply to presentation, but IFRS 18 also has some specific requirements in relation to disclosure about operating expenses in the notes. And do you want to walk us through that as well, Juliana, this fun part of our project?
Of course. So this was a topic on which we received strong feedback from both preparers and users. Users find information about expenses by nature very helpful for their analysis, but some preparers told us how difficult it would be to actually provide detailed information, because it's not currently available from their reporting systems. The IASB has spent a lot of time discussing various approaches with stakeholders and has finally arrived at a compromise that balances the needs of users with the cost for preparers. So IFRS 18 requires a company that presents one or more operating expenses classified by function in the statement of profit or loss to disclose in a single note the amount of expenses included in each line item in the operating category for depreciation, amortization, employee benefits, impairment of non-financial assets, and write-down of inventories.
So you have listed here 5 specific nature items that companies that report by function would be required to disclose in the notes, and you have explained how this information would be useful for investors in forecasting future cash flows, which is what they use by nature information for, as well as linkages to statement of cash flows, right? But as we refer to, the reason we describe this as a fun part of the project is there's the other side that getting this information can be quite costly for some companies. And you said IASB arrived at compromise. So do you mind walking us through what has IASB done to mitigate the cost of preparers to providing this information?
Sure. So in addition to limiting the expenses to the 5 items that I've just mentioned, another step to reducing cost is that IFRS 18 does not require a company to disclose expense amounts. A company could instead disclose amounts for which part of the amount has been recognized as part of the carrying amount of an asset. This means companies can use information that they're currently already collecting from their systems, such as depreciation charge. However, if that's the case, so if a company does not disclose the expense amounts, then a company would need to provide a qualitative explanation of that fact and also identify the assets involved.
Thank you so much, and I hope our viewers are getting a picture of what this disclosure could look like, but I think we also have actual examples. So, Juliana, do you want to walk us through the example of this disclosure as well?
Sure. So this slide shows an example of the requirement to disclose the amount of depreciation, amortization, employee benefits, impairment of non-financial assets, and write-down of inventories included in each line item in the operating category of the statement of profit or loss. Now, here we can see the amounts disclosed in this example are those the company has recognized as expenses in the period, except for depreciation and employee benefits. The amounts disclosed for depreciation and employee benefits in this example represent instead the charge or costs incurred for the period and include amounts that have been capitalized by including them in the carrying amount of inventory. Now, this slide does not illustrate all the disclosure requirements for specified expenses by nature, so please also take a look at the illustrative example that we have published alongside IFRS 18 for the full disclosure.
Thank you so much, Juliana. And as you said, we have this in the package of materials that is on the website, and do encourage our viewers to look at that. It's very useful, and great work on the examples as well, by the way. So now we have covered topics relating to disaggregation. We talked about roles of primary financial statements and the notes. We talked about principles of aggregation and disaggregation and what does this mean for items described as other. And we talked about specific requirements relating to operating expenses and their presentation and disclosures. And we said we will also cover today limited changes IASB has made to IAS 7 statement of cash flows as a result of work on this project. And Metma, if I can turn over back to you, please, if you don't mind. And do you mind walking us through these changes to IAS 7 as a result of work on IFRS 18?
Sure. So when it issued IFRS 18, the IASB also amended IAS 7 to require companies to use the operating profit or loss subtotal as the starting point for the indirect method of reporting cash flows from operating activities, and to introduce new requirements for the classification of interest and dividend cash flows in the statement of cash flows. The amendments were made in response to requests from investors to improve the comparability of a company's statement of cash flows by reducing ways in which the statement may be presented. By requiring all companies to use the operating profit subtotal as a consistent starting point for the indirect method of reporting cash flows from operating activities, will help investors analyze and compare companies' operating cash flows. Before the amendments, companies could choose to classify interest and dividend cash flows as either operating, investing, or financing activities in its statement of cash flows. As a result, classification varied even among companies in the same industry. The IASB decided to remove the classification choice for most companies to increase the comparability. Most companies will be required to classify interest and dividends received as cash flows from investing activities and interest and dividends paid as cash flows from financing activities. Companies with specified main business activities are required to classify the total of each type of cash flows, that is, dividends received, interest paid, and interest received, in a single category of the statement of cash flows, even if the associated income and expenses are classified in more than one category in the statement of profit or loss. Dividends paid would be classified as cash flow from financing activities, the same as for other companies. If our viewers would like to know more about what these specified main business activities are, we invite them to refer to webinar 1 of this series.
Thank you so much, Metma. And just to remind everyone, so recordings of the webinars and other materials you can find on IFRS 18 implementation page on our website, and the questions have flooded in. But before we start answering the questions, Juliana, if I can just turn back to you quickly, just to give us overview of effective dates, and again, remind us of all the materials we have for IFRS 18.
Of course. So to give companies sufficient time to prepare, IFRS 18 is effective for periods beginning on or after 1 January 2027. Early application is permitted, but it is also important to note that IFRS 18 will be applied retrospectively and to interim financial statements. Now, we sometimes hear that because IFRS 18 is not about recognition and measurement, it would be easier for companies to adopt to the new standard. However, we do encourage companies to start their implementation efforts early. For example, the new requirements for subtotals and categories in the statement of profit or loss and the enhanced requirements for grouping of information will require companies to carefully consider their current presentation and also what to include in the notes. In addition, the new requirement for companies that present one or more line items by function to disclose information about specified expenses by nature, which we just talked about, might require changes to systems and processes and might take some time to implement. Regarding the published materials, for those interested in finding out more, this slide includes the published materials related to IFRS 18, which are available on our website. These materials include the illustrative examples, but also flowcharts explaining requirements, as well as the effects analysis, which we hope will help our viewers with the transition process.
Thank you so much, Juliana, and I'll give you just a little bit break and start questions with a question for Anne. So Anne, when we were talking about rules of primary financial statements and the notes, we also said IFRS 18 has requirements relating to linkages for information between the two, and the viewer has asked, how does IFRS 18 do that, and can you explain in a little bit more detail what this requirement is? We can't hear you, Anne.
Better, yes.
Yeah.
So Metmer explained that IFRS 18 requires clear linkages between the primary financial statements and the disclosures in the notes, and that they go both ways. So we have in IFRS 18 brought forward from the existing requirement in IAS 1 for a company to cross-reference each item in the primary financial statements to any information related to that amount in the notes. And then IFRS 18 goes one step further, and as a new requirement, also requires a company to disclose the line items that include the amounts disclosed in the notes, if those amounts disclosed are included in a line item in the primary financial statements.
Thank you. Thank you so much, Anne, for that. So, hopefully not too onerous requirements, because there's no quantitative information required to be provided, but simply to help users understand the linkages to indicate what items relate to if it's not apparent, right? And Juliana, I think you had enough break now, right? So can I ask you a question that's come in, and it relates to topic that you explained earlier. So, these aggregation characteristics and, how you apply principles of aggregation and disaggregation. So a viewer has asked if you can give an example of how characteristics would apply.
Sure. Let me illustrate the requirements using one of our examples in IFRS 18. An entity might present in the statement of financial position financial assets that comprise both equity investments and debt investments separately from non-financial assets. Now, the financial assets have dissimilar characteristics because they have different measurement bases. Some are measured at fair value through profit or loss, and others are measured at amortized cost. The entity might therefore determine that to provide a useful structured summary, it is necessary to present line items that disaggregate these financial assets based on their measurement basis. That disaggregation would then result in a line item comprising equity investments and debt investments measured at fair value through profit or loss, and a line item comprising debt investments measured at amortized cost. Now, because equity investments are dissimilar to debt investments in that each exposes the entity to different risks, the entity would then additionally assess whether further disaggregation in the statement of financial position is needed.
Thank you so much, Juliana. And as you said, again, another reason for you to go back to the materials and refer to example that's explained in more detail there. But we had another question come in, and this is relating to topic and explain, but Methma, I know you worked very hard on this particular topic, so if I can ask this question of you, and this is about rules of primary financial statements and the new concept that we have of useful structured summary. And the viewer is asking, does this override other presentation requirements? For example, requirements in IFRS 18 to present subtotals like operating profit or minimum line item requirement from IAS 1.
Sure, I can explain. So the objective of the required subtotals and categories is to provide a comparable structure in the statement of profit or loss. As a result, they are always considered necessary for the statement to provide a useful structured summary and would be required. IFRS 18 has removed the idea of minimum line items and instead retains the list from IAS 1 as items that might be necessary for the statement of profit or loss and the statement of financial position to provide useful structured summaries. Presenting these items is not required unless they are necessary for the statements to provide useful structured summaries. However, there is still a requirement to disclose these items in the notes if they are material.
Thank you so much, Methma. So useful structured summary very much is pervasive, but there are some areas where IASB has deemed that they're always necessary to provide useful structured summary. So there's no override there, just like you explained. So I hope that's clear now to our viewers. There are some, I'm jumping a little bit between topics as questions are coming. And there was one that relates to what viewer has described insignificant items. So the question was how to report on insignificant items, for example, if interest income on cash is insignificant. And we know, if we listen to the first webinar, that will be classified in the investing category, and the entity has nothing else that is to be classified in the investing category. So the viewer is asking, should that item be combined with some other items? And in that case, which other items?
Yeah, sure. So if I replace the phrase insignificant with the term immaterial, because the threshold we use about disclosing or presenting information is about materiality. So if your interest income is immaterial, then we wouldn't expect you to create a category or a line item on the face of the statement of profit or loss for an immaterial item. So you would combine it with some other item, and it wouldn't matter which item you combined it with. If the amount is immaterial, you can present it, disclose it with whatever other item you feel is most sensible, because there's no material information provided by it.
Thank you so much, and it goes back right to what you were explaining earlier, that materiality very much applies in the same way, and there is absolutely no requirement to disclose or present information if immaterial. Yeah. And useful structured summary then only comes once information is material, right? So just coming back, linking maybe to that, if items are material, so the coming back to aggregation and disaggregation requirements, and we had a question asking for example of characteristics to consider when aggregating and disaggregating information in the financial statements. And then, given that we started, can I just stay with you on this question and get example?
So the characteristics, IFRS 18 includes examples of characteristics that you would use to think about for aggregating and disaggregating items, and it gives examples of characteristics that relate to the statement of profit or loss and the statement of financial position. And examples of characteristics that it gives are nature, function, measurement basis, the risk associated with the item, the uncertainty around it, and in terms of amounts in the statement of profit or loss, thinking about persistence, whether things are likely to continue or whether this is like a one-off item. So there is guidance in IFRS 18, or there are examples of things that companies would need to think about in determining how to aggregate and disaggregate information.
Thank you so much, Anne, for that explanation. And I think we give Anne a little bit break, but not too long probably. But if I can turn back to you, Methma, and there was a question about additional subtotals in the statement of profit or loss and whether companies can present additional subtotal. So the question is if a subtotal is necessary for useful structured summary, but it also meets definition of a management defined performance measure, which we covered in previous webinar, is it possible to keep this subtotal in the P&L as well?
So IFRS 18 requires companies to present an additional subtotal if such presentation is necessary for a primary financial statement to provide a useful structured summary, and the subtotal meet 4 criteria. So the criteria are that the subtotal comprises amounts recognized and measured in accordance with IFRS accounting standards. The subtotal is compatible with the structure of the statement of profit or loss. The subtotal is consistent from period to period. The subtotal is displayed no more prominently than the totals and subtotals required by IFRS accounting standards. Some additional subtotals, such as gross profit, operating profit before depreciation, amortization, and impairments within the scope of IAS 36, and operating profit or loss and income and expenses from all investments accounted for using the equity method, are excluded from the definition of MPMs.
Thank you, Methma. So coming back to the question asked, where the viewer said, if it meets definition of MPM, does it somehow influence its presentation? And I think what you're saying is that it doesn't. So the requirements apply, how they apply, and it may be that actually subtotal that is also an MPM is presented in the statement of profit or loss. And I think we may covered separately in the previous webinar that doesn't mean that all MPMs can be presented on the statement of profit or loss, exactly for the reasons you mentioned, Methma, because requirements for structure have to apply regardless. So if MPM combines items from different categories, then it would not be possible to present it. But nevertheless, some MPMs may be presented, and the requirement for single note disclosure for MPM would still apply. So I've kind of maybe veered a little bit too much in the topic of the last webinar, but as you can see very clearly, IFRS 18 is a package of it's hard to look at one in isolation of the others. So thank you so much for that, Methma, and giving you a break now. And I think, Juliana, you had a bit of break waiting there. So let's see what questions we have come in. This is a more fun topic, and everybody will remember this is about operating expenses by nature and function. And our question was, does IFRS 18 allow companies to use combination of nature and function when presenting operating expenses as opposed to policy choice we have in IAS 1 today?
So many stakeholders raised concerns about prohibiting a mixed presentation because it might result in a loss of relevant information, particularly for conglomerates, so companies with more than one main business activity. And the IASB also observed that the specified line items inevitably lead to a mixing of nature and functional line items. And In addition, some operating expenses, for example, goodwill impairment, may be difficult to allocate to functional line items in a non-arbitrary way. So hence presenting goodwill impairment separately would help provide that useful structured summary of a company's expenses. Therefore, the IASB is of the view that sometimes a mixed presentation does provide the most useful information to investors. But the IASB has also provided application guidance to ensure that users are able to compare companies' line items and ensure that the items are labeled faithfully if a mixed presentation is used. So to give you an example, if depreciation is presented separately in the statement of profit or loss, but some functional line items also presented include parts of that, include some depreciation, then those line items need to be labeled faithfully so that it is clear to investors what they comprise.
Thank you so much for that. And I'm just looking at questions here. There's a couple of more related questions to operating expenses. So Juliana, if I can stay with you, and we all know you love talking about this topic, so this won't be challenging, I hope. So one question has come in asking, and so employee benefits is one of the 5 specific items by nature that companies that present operating expense by function or phase need to disaggregate, and the viewer is asking what is included in employee benefits.
So the requirement is such that it relates to employee benefits as determined by IAS 19. So in this case, for example, that would also include pension costs.
Mm-hmm. Thank you so much. So it is really, we are not defining, providing new definition of these items, but simply providing helpful guidance to which standards you refer to identify that information, right?
Exactly. All expenses have a reference to a respective standard.
And you will see lots of cross-references in IFRS 18 exactly with that objective to just help guide, navigate, and coming back to this, IFRS 18 is all about relationships, and there's lots of relationships and connections. So you will see that across, and we hope you find it useful. But we also have flowcharts at the end of illustrative examples that are useful to give you high-level overview of requirements. If sometimes the detail of paragraphs in IFRS 18 with all the references can maybe seem a bit much to start with, but then when you get into it, I think it will all make sense, right? Because your drafting is wonderful and correct. So, Juliana, I think you deserved a little bit break, and let's see who is next. Shall we go to you? And let's see what we have here. All right. So, and there's one question that relates, actually a couple of questions here I can see relates to another one of topics that you worked very hard on during this project, but it hasn't quite made it into final standards, so we didn't cover it in our presentation. And the viewer is asking, why did IASB withdraw the proposal that was in the exposure draft to require disclosure of unusual income and expenses? And if I can ask you immediately related question to that is also then, where will investors be able to find this information, given that there's no specific no disclosure anymore?
Yeah, sure. So this was a hotly debated topic in the development of IFRS 18. The exposure draft included a proposal that companies would have to disclose information about unusual income and expenses, and it included the definition of unusual income and expenses. And the response back was from many stakeholders was that it was good to require disclosure of unusual income and expenses, but the response was also complete disagreement with the definition that had been proposed and no consensus on what definition would be acceptable across different stakeholders. So we spent a lot of time trying to find a way of defining unusual income and expenses in a way that would gain support. And we realised that we couldn't, that the definition in the exposure draft relied very heavily on the idea of persistence, and that clearly is part of what forms, that creates unusual income and expenses. But there was also clearly something else that people wanted in that definition relating to, the nature of the item being unusual for that company, and that we could not pin down for all companies. So we didn't proceed with the specific proposals in the exposure draft, but that's not to say that under IFRS 18, there aren't requirements that would lead to companies giving information about unusual income and expenses, because as we've talked about, you need to disclose information if it's material, and you need to think about what characteristics would give rise to material information. And one of the characteristics that's an example in IFRS 18 is persistence. And what we expect will happen is that companies will think about what information do investors need about their company, what would be material. And if they have things that they regard as unusual, they would disclose them because it would be material information. They would also need to explain if they, what definition of unusual income and expenses had they used, how had they identified these items as being unusual, because they would need to describe them and label them in a way that gives a faithful representation. And that would include the definition that they had used to identify these things as being unusual income and expenses. So although the key message is, I guess, that although the IASB did not proceed with the specific proposals, that doesn't mean that the other requirements in IFRS 18 mean you can ignore them. You need to think about characteristics, including persistence and unusual for the company, and using the idea that of materiality in disclosing material information, a company would then disclose information about unusual income and expenses.
Thank you so much, Anne, and thank you for that, wrap up at the end to say this doesn't mean that we don't expect this information in the financial statements, but it's just covered in general way rather than through specific requirement that was proposed in the ED. And Anne, if I can stay with you, and I think this is quite important. I know you explained it in our presentation, but given that it's a new concept of useful structured summary, and it's often a question we receive about interaction of that with materiality, whether only the viewer specifically asked, so what if you have circumstances where if something is material by size, but it doesn't provide useful structured summary, and if this is in the list of line items to be presented, does it still need to be presented? So do you mind just again maybe explaining and talking through? I think repetition here would be quite useful.
Yes, sure, of course. So starting with the concept of materiality, if information is material, it should be disclosed or presented. So somewhere in the financial statements, that information should be given. And that's the concept of materiality, and that's the same as it's always been. And then the question is, if is that material information, is that needed to be included in the primary financial statements in order for the primary financial statements to give a useful structured summary? And sometimes the answer will be yes, and sometimes the answer will be no. So, for example, an obvious example, revenue, is going to be material. It is also likely, very likely, to be part of a useful structured summary in the statement of profit or loss. So you would put revenue on the face. You might then disaggregate that revenue into different types of revenue in the notes. The disaggregation of the different types of revenue that's in the notes, that disaggregation, although it's material information, that's why you're giving it in the notes, but it might not be needed to be presented in that disaggregated way in the statement of profit or loss, because it's not needed for a useful structured summary of the income and expenses. I don't know if that helps answer the question, or if you'd like me to expand further, Aida.
I think, it seems pretty clear to me, but again, because it's a new concept, I'm again going to advertise our, materials and flow charts. It may be useful to look at that and perhaps listen to this again if it doesn't, because it took us quite a while to sink in. I'm one of those people at the beginning, what, how are we going to do this? And then, of course, it makes perfect sense. And then when you understand, it's really like, how did we live without this all these years? Is the question we ask ourselves now, right? Thank you. So thank you so much, and I will monitor if there's more questions on this, and we can come back. Although we don't have too much time, we have about 5 minutes left, but we can cover a few more questions. So there is one somewhat related to this, but Juliana, if okay, I give Anne a bit of break and ask you these questions, or we can answer it together. So the viewer has asked, if you don't have material income and expenses in the investing category, are the companies still required to present subtotal profit or loss before financing and income taxes? Do you mind, because I know we chatted about this, didn't we, as developing requirements? So do you want to walk us through this question example?
So generally, companies are required to present both of these new required subtotals, operating profit and profit before financing and income taxes. Now, it may well be the case that the investing category is quite small. Like you said, there is an immaterial item sitting there. Nevertheless, I think generally we would expect at least one line item there in that investing category, which would then mean you would have to present this specific subtotal.
Indeed, and even if there's no line items, if there's no material information in that category, like in the example that in the question you answered, and then we would still expect indication that the amount that represents operating profits also represents profit before financing and income tax, and that becomes relevant when we think of digital reporting as well. And I can see we have a question on digital reporting as well, Juliana. But if I can hold off with that question just for 1 second, because there was another question come in that I want to ask Methma, and then I'll come back to you. So Methma, we had a question coming back to our requirements for aggregation and disaggregation, so grouping of information, and just again asking, how will this affect companies? What does this mean in practice? And I think this is quite important question to answer. So if you don't mind, we can cover it quickly, even though we only have 2 minutes now.
Yeah. So the requirements for disaggregation and aggregation will apply to all primary financial statements and the notes, and companies will have to assess whether they need to make any changes to their financial statements as a result of the new requirements. But the extent of these changes needed will be company specific, and the requirements are an opportunity for the companies to revisit their current presentations and disclosures and make changes that will provide more useful information to their users of financial statements.
Thank you so much, Methma. So very much company specific, but we have walked through various examples in this webinar in answering questions that may be helpful to you. And I think another point that's important to emphasize here is that these requirements for some companies mean that they disclose more. For some companies, it may mean that they disclose less, because they go both ways, and both in the notes and presentation in the primary financial statements, because as we said, these requirements apply across the board to entire set of financial statements. So I think that's important to bear in mind, and that it's very much entity specific, like you said. But as promised, as a finale, Juliana, can we finish by answering this question on digital reporting? And what about digital reporting? One of our viewers asked, are we looking into that?
We are. So the presentation and disclosure requirements that introduced by IFRS 18 will be reflected in the IFRS accounting taxonomy. And the IASB is currently actually consulting on a proposed update to that taxonomy. Now, IFRS 18 enhances the structure of the statement of profit or loss and improves comparability of information about companies' financial performance, alongside, of course, also introducing specific disclosure requirements like for MPMs or specified expenses by nature. And this proposed update to the IFRS accounting taxonomy would extend these benefits to digital reporting, allowing investors and users of digital financial statements to efficiently search, extract, and compare statements prepared in accordance with IFRS 18. And last but not least, the IASB is also conducting a fieldwork exercise to test the proposed modeling during the public consultation period in June, July, and August of this year.
Thank you so much, Juliana. And we have, I think, some nice video around there about this exercise, and we encourage our viewers to look it up. I think it's all over LinkedIn currently, and I think the deadline is about end of this week or beginning of the next week, right? So we still have time if some of our viewers are in digital reporting and they like to participate. I think this is a great opportunity. But I think with this, I have just thanks to give now at the end. I think we have a couple of questions we haven't answered, but we're out of time now, so our apologies for that. So I just want to wrap up and remind in wrapping up our viewers that we have lots of materials on IFRS 18, as we mentioned, probably 15 times during the presentation, but I think this is really important that you look at the range of materials we have there. And in relation to this specific webinar, please, we very much look forward to your feedback on, what you thought of this webinar, and you can use it by using this QR code that you see on the slide here. And thank you so much for your time in joining us here today, time that you spent on learning about IFRS 18 and investing effort in your implementation. We very much look forward to seeing the outcomes of that. And thank you so much to wonderful team members, to Juliana, to Anne, to Mesma, for joining us today and helping me answer all these difficult questions, of which you have done a wonderful job. Thank you so much, and goodbye, everyone.
Bye-bye.